Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my own website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz or at Banking Day. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 28 in our series for 2024, and today's date is Friday, August the 9th. First, I'll be talking to Paul Koopmans, the Australian-New Zealand Vice President of Worldpay, on the growth of digital wallets, which are projected to grow by 45% in Australia of all e-commerce transactions by 2027, as cash and card use declines. The use of digital wallets at the point of sale, or POS terminals, is projected to double from 15% in 2023 to 30% of the POS market size of $789 billion in 2027. And I will talk to AMP Capital Chief Economist Shane Oliver about the latest inflation figures. But first, let's talk to Paul Koopmans.
Well, Paul, tell us about the rise of digital wallets.
Yeah, thanks, Leon. So the research that's come out of Worldpay's Global Payment Report in 2024, what it tells us that the digital wallets as a payment preference now account for 50% of all global e-commerce spend, and that's predicted to increase heading into 2027. So it's definitely the people's payment choice.
What's driven that?
I think there's a few things. So, obviously coming off the back of the pandemic, we saw a significant decline of cash. I think you're seeing a fairly big generation shift. So, digital natives coming into the market that have been sort of weaned in on digitisation. And there's a couple of other things as well. So obviously the use of contactless payment adoptions as well. And there's just no denying just the ease and use and the extra security of being able to use these digital wallets, through your phone. And I think trust is another big, component as well, Leon. So I think all of those factors play a key part in the rise of digital wallet usage.
That's interesting because I haven't used cash since the pandemic at all.
No, well, I mean, you can leave the house without your wallet now, can't you? So, I actually, went for a walk the other day to get my morning coffee and was just able to put my watch on and just, make that payment with my watch. So it's certainly a lot easier these days and you don't have to rely on having cash in your back pocket.
Yeah, you can do it with your watch or your smartphone.
Absolutely.
Very easy. Yeah, so I mean that's fascinating that it's happening now, and you expect that to grow to 2027?
Yeah, we do. We forecast that it will be the leading payment method online, across all regions. And what I think is an interesting piece is that consumers in APAC, when we talk about APAC, we're talking more than sort of the Asian markets. So digital wallet usage in those markets accounts for 70% of all e-com transactions. Now that's a number that's really strongly driven out of the Chinese market, where wallets account for 82% of all transactions, which is a staggering amount, and that's really driven out of these large super apps like WeChat Pay and AliChat Pay. So that's a massive trend happening out of the APAC market.
What do you expect a growth in the number of apps offering this?
Well, so what we're seeing is you're obviously seeing a lot of dominance from large technology players, especially in developed markets. So you're obviously seeing the major players like Apple, Google, and PayPal, are very strong and have a large presence in ANZ within North America and also the European markets. But you also see a lot of dominance within developing nations where they use local providers. So I mentioned there out of China the use of WeChat Pay and also Alipay. But then in markets like Africa and also LATAM, they really sort of rely on local providers. So that have to compete with these global players.
And we're expecting this to grow massively in the APAC region as a result.
Yeah, no doubt at all. So, I mean, the use of traditional cards, so debit and credit cards, continues to grow, but that's now being used as a pass through to digital wallets.
Which assumes that everyone will have a smartphone or an Apple Watch.
Yeah, or I mean, we're also talking about when we talk about e-com. So there's obviously you're able to use wallets. So you're able to use now Apple Pay when you pay for a item online, as well as obviously the convenience of just doing it through your smartphone.
Were you expecting more app developers to get into this?
Well, look, potentially. I mean, it's obviously a very competitive market space, but once again, it's dominated by large technology firms. And also, within those developing markets, technology providers that have been able to provide financial resources to consumers that are either underbanked or unbanked.
Are there ways to improve it?
Well, I think there's always going to be areas where things are going to be fine-tuned and tweaked. So, you're seeing things like, account to account and pay by bank, come into the market as well. So, things like consumers being incentivized through using different payment methods, with rewards that they can use, for shopping and things like that. So I think they will be improvements. And also another big improvement, Leon, has got to be around fraud. So as the market continues to digitise, there's a lot of pressure on the industry to ensure that there's a big mitigation around fraud.
And I'd imagine AI would be playing a key role in that growth.
100%. So I think that's what we're going to see in the future. AI and machine learning play a major part in the reduction of fraud. There's no doubt about it.
But at the same time, AI would be generating a lot of the fraud as well.
Oh, well, absolutely. So it's obviously a double-edged sword, as you said.
Right. I mean, one of the key things I'd noticed one or two, some fintechs are using this now, is to detect fraud is tokenization and geolocation.
Absolutely. So there is obviously tokenization, within these digital wallets, and Apple's one of the first ones to introduce that concept, and that is where this very confidential data of your personal account number on your card is replaced with a digital token. So that means the merchant is not handling that sensitive information, and that's obviously passed through to the schemes who swap that out for a token. And there's a lot more, I guess, protection involved for the consumer and also the merchants who handle that information.
Geolocation would also be critical too.
So when you talk about location.
Yeah, location of the the person making the transaction, wherever the transaction's happening, you have to be sure it's happening to that particular smartphone in that particular location for that particular customer.
Yeah, no, absolutely. So there's obviously a lot of machine learning and AI involved in I guess the patterns of spending with certain consumers, but there's also ways to alert your issuing card provider in terms of when you're going on holiday and things like that, just to ensure there's no sort of, I guess, false declines when making purchases online or when you're overseas.
I'd imagine one of the keys with AI is for the fintech or the bank or whoever to actually run all that data through their AI system and to detect where the fraud's happening and all of that sort of stuff.
100%. So, I mean, Worldpay, for instance, we transact around 40 billion, transactions, per year. So that obviously gives us a rich database of information that we can use, to help merchants, not just detect fraud, but also improve their, authorization rates and improve their, top line revenue as well. So, having access to more information, I guess, improves that process.
So, what are your projections for 2025?
Well, the one thing we can guarantee is it's a fast evolving, landscape. So, the one we spoke about, definitely we will see AI, become a more effective tool for the mitigation, of fraud. And then we also talk about, things like the Internet of Things. So, your everyday items that you interact with becoming payment devices. So whether that's, the car you drive, being able to pay for parking or pay for petrol at the Bowser, or, even having your fridge as a payment device. So there's some of the things that we'll continue to see develop, but I think you will see more usage and more uptake of digital wallets into the future, and that move away from cash, from card, into the digital wallet space.
So into the Internet of Things, so you could actually order your stuff from your fridge?
Absolutely. So, it can order, I guess, manage, item levels within your fridge and then make those orders on your behalf. You may be having payment devices in your activewear that you're wearing outside of your watch, maybe into your shoes. So there's going to be a lot of, I guess, use cases where that will evolve over time.
Okay. And I mean, you could even do it obviously you could do it from your computer, from your laptop, and your TV set.
Absolutely. And what you're seeing as well now is Apple, developing this augmented reality with their Vision Pro. So that is a way that you can put goggles on, you can shop. They've got an avatar of consumers within that device. You can try on items, choose items, and then through your eyes, you can move to a certain area of that site and pay for items and check out. So it's certainly developing at pace.
So they would be working with the retail sector for that as well.
100%. Yep. So that's currently in the market now. So you'll see that technology evolve, and then also other competitors, come into the space.
So that'll be fascinating to see how the retail sector adjusts to that.
Yeah, and just I guess the adoption, the uptake of the consumers, I guess, on how comfortable they are wearing those. You don't want to see people walking around the streets with, I guess, reality glasses on and bumping into people and that sort of thing. So how it will actually roll out and work, I guess, will remain to be seen.
And the other thing that would work would be hotels and accommodation.
Yeah, absolutely. So just, express checkout and just, everything is just, I guess, consolidated, into the one area during your stay. So yeah, absolutely. They'll look at right across the industry to look at ways where they can, improve the user experience.
Well, Paul, it's been fascinating talking to you, and thank you so much for your time.
Good on you, Leon. Thank you.
Thank you.
And now let's talk to AMP Capital Chief Economist Shane Oliver.
Well, Shane, the inflation figures come out and they look quite encouraging. What's your view?
Look, they certainly were. There was a lot of fear going into the release of those inflation figures, and the fear was partly engendered because we got some monthly inflation data. The ABS has a new monthly inflation indicator for March, April, May, which had shown a progressive rise in inflation. And that had led many to fear that we were going to see, quite a blowout in inflation for the June quarter as a whole. And that wasn't borne out, particularly in relation to both the headline rate, 3.8%, which was in line with RBA expectations, and the trim mean, which came in at 3.9%, which is actually down slightly from 4%. But the big fear was, based on the monthly numbers, that you'd get a bit of a blowout. That turned out not to be the case, but it had led some to talk about a couple more rate hikes. At one stage there, the money market had factored in a 70% probability of another hike. A lot of those fears have been wound back a little bit from the money market, but after the release of the inflation figures, the money market is now actually factoring in the next move being rate cuts, but not till February next year.
Right, okay. Well, it's interesting because the next quarterly figures come out in October, don't they?
Yes, late October. We're going to get monthly figures along the way in late August for July, and then late September for August. But the most important one will be the October release. I suspect that it will show a sharp fall in the headline rate, because we know the government has announced various cost of living measures, the $300 energy bill rebate, various other things, $1,000 energy bill rebate in Queensland, various amounts in other states, rent relief, lower pharmaceutical costs, and so on. So you could well see September quarter inflation come in very low, maybe around 0.2%, which would take the annual rate of inflation below the 3% level, possibly down to 2.8%. Obviously, the RBA will look through that to some degree because it's partly based on government subsidies, and they'll focus on the trim mean or the underlying measures, but I suspect they will probably show a further fall as well. So to be honest with you, I think we've seen the peak in inflation. I think we're going to follow a similar pattern to what you've seen in other countries like the US, like Canada. They went through inflation scares along the way. Those countries saw their inflation take off before we did, 3 to 6 months before. They peaked 3 to 6 months before us, and we're following them 3 to 6 months behind on the way down. That just reflects slightly different economic cycles. So I think we're going to see lower inflation numbers released in the months ahead, but particularly for those September quarter numbers.
So despite that disinflation coming in, we're still not expecting a rate cut till February?
That's right. We don't expect a cut till February. I think that's in line with money market expectations. There is some chance that you might get one in November or December, but I think to get that, personally, I think that's what they should do, but what they should do is different to what they will do. I don't think the RBA will be confident enough to be cutting by November or December, for the simple reason that even though the headline inflation rates will be down on the back of the cost of living measures, they'll still be waiting to see what's the full impact of the tax cuts, has that boosted spending, how's the economy travelling, and so on. So I think it's going to take more than one quarterly release to get them to start cutting interest rates. I think they probably want another 6 months, a couple more quarterly inflation numbers before they get confident. I think they will get confident. It's just going to take time before they get to that point. Because don't forget, inflation is still 3.8%. That's still too high. And the trim mean, the underlying measure, is 3.9%. That's still too high. So it seems a bit unlikely they're going to be rushing to cut in November or December. That said, it could happen, But I think you'd have to have much weaker economic activity data to get that, or some sort of crisis in financial markets, which triggers a quick about turn by the Reserve Bank. Like we saw at the time of the GFC, they were hiking earlier in the year, and then by September 2008, they had to start cutting.
Right, and but I mean, Powell has indicated a rate cut in September.
Powell has, and Powell, like the RBA, has been all over the place. The Fed's been all over the place. Earlier this year, they were talking about potential rate hikes as we got that higher inflation numbers come through. And now they're pivoting back towards rate cuts. So it's been a volatile ride. But just bear in mind that the Fed started pivoting towards allowing for rate cuts, removing rate hikes back in December last year. The RBA never had to pivot towards rate cuts. They've always been, ways behind the Fed. So I think if you look globally, we are moving into a consistent easing pattern from central banks. Started with the Swiss central bank, Sweden, Canada a couple of weeks back, ECB a couple of weeks back, possibly the Bank of England getting there, and the Fed will get there by September. And in fact, by September, I think we'll be well into an easing cycle. Probably by then, we'll even see the Reserve Bank of New Zealand cutting rates. But we're a little bit behind. I don't think that tells us anything that our economy is hopeless or anything like that. But we've got 3.8% inflation. These other countries tend to have somewhat lower inflation. They're further ahead in terms of getting inflation down. Not through any fault of Australia's, but because their inflation took off earlier in the first place, and they started to raise interest rates earlier than us. So I think, yes, what we're seeing globally is a positive sign. That's the direction we're heading in, but we're going to be laggards to the party, so to speak.
Well, that's interesting because, I mean, the inflation figures show that fruits and vegetables were up, but that was more due to seasonal factors.
It was. There's always a bunch of abnormalities in there, seasonal factors. Like you run through the CPI, a big factor behind the rise in the CPI is government-related charges and administered prices. Areas like, if you take the last 12 months, health up 5.7%, very heavily influenced by government. Education over the last 12 months up 5.6%, again, very heavily influenced by government. Transport is obviously up 4.6%. That's, again, influenced by petrol prices, and also there's an element in there of vehicle registration rates, which are indexed to past inflation. So some of these things, you could argue, are beyond the control of the Reserve Bank. Look at alcohol and tobacco up 6.8%. Big driver there is annual excise increases, which are indexed to inflation, or in the case of tobacco, to wages. So that's just going up because past inflation went up. So there's a lot of bits and pieces in there which is still keeping the numbers high, which are either due to government decisions or government administration influence or indexing to past inflation rises. And those things will start to come down. I mean, there is an argument to say, well, there's not much the Reserve Bank can do about all those things. It's not the free market part of the economy. It's a government part. It's really something for government to do something about. But the Reserve Bank would also say, well, we just want a lower inflation rate generally. If that means lower inflation in the other areas of the economy, then so be it. So it makes life more difficult for the Reserve Bank to have all these items still going up.
Well, the other issue too is you've got rents and house prices. They're rising, right. But that's outside the control of the Reserve Bank.
It is outside the control of the Reserve Bank, or not completely outside the control. The reason we have a housing crisis is government-related. Seriously, it's
yes.
Government-related. They make it more difficult to build new homes because they control zoning and what have you. They pump more people into the economy than we can supply with houses. So that's, again, a government decision. So it's very much a government-impacted problem, the housing shortfall. And that's affected rents. Yes, again, the Reserve Bank can't do much about that in the short term. It can have an influence, though, if you raise interest rates, and that does make it harder for some people to keep buying homes and pushing out house prices. But it's a difficult one for the Reserve Bank to fix up. But again, these things, government-related influences boosting the CPI, you can actually do a chart of it. You look at those things influenced by government in some way, they're running around 5%. Market-related stuff is running around closer to 3%. So that tells me that government is playing a role here in keeping inflation higher than it should be. The problem for the Reserve Bank is that it has to focus on the overall rate of inflation. And if these sticky government-related areas remain a problem, I actually think they'll start to fade a little bit. But if they remain a problem, that means you have to get lower inflation in other parts of the economy. And the market sector. And that means you higher interest rates for longer to achieve that. So it's a difficult one for the RBA. The other thing to bear in mind, if you take university costs, they're up something like 6 or 7% on a year ago, and that was because of annual increases in university fees. And guess what they were indexed to? They were indexed to the inflation rate about a year or so ago. So again, it's a bit backward looking, nothing to do with supply and demand forces, but again, due to indexing. So it's either these administered items or indexed items which are causing part of the problem at present, just making life a little bit more difficult for the Reserve Bank. But it still has an overall mandate to get total inflation down, and I suspect that that's what it'll be focused on.
Which means we'll probably look at a rate cut by February, maybe next year.
That's right. I think when the RBA meets in the week ahead, they've got another meeting next Tuesday, first Tuesday in August. They will probably indicate that, things are going according to plan, but inflation is still a bit too high. They're still lacking the confidence needed to start bringing rates down. It's a similar line of thought to what the Fed expressed, that it wants to see more confidence. If you read the Fed statement released from their July meeting, they want to see more confidence that inflation is coming down. But then you heard Powell say in the press conference that he's starting to get more confidence. He's not there yet, but he's starting to get more confidence. So the RBA is saying the exact same thing. We want to see more confidence, but they're not yet saying we've got that or we're getting that confidence. And so that's the difference between the RBA and the Fed. Both still waiting for more confidence. The Fed's starting to get that more confidence, but the RBA is not yet. And it means they meet, they leave rates on hold. They probably indicate that inflation is still high, still implies some upside risk to interest rates. But they also say that it's still too early to start talking about rate cuts.
So we'll probably be looking at a rate cut around about February, because the RBA will be confident by then, or more confident, that inflation will be sustainably low.
That's right. I think by February they will have got the September quarter inflation numbers and the December quarter inflation numbers, and they will then provide the confidence that inflation is coming down sustainably towards its target of 2 to 3%, and then they will be in a position to cut rates. And of course, at the same time, they'll probably see more evidence of higher unemployment, ongoing softish growth in the economy, and all of those things will fall into a place to justify a cut, just like we're seeing in other countries, just several months behind where those other countries are.
Indeed. Well, Shane, look, thank you so much for your time.
My pleasure, Leon. Take care.
So what's happening in the news? Well, fears of a US recession have gripped global markets, triggering a share market rout that prompted investors across Asia, Europe and North America to all unwind their positions at the same time. The severe plunge raised questions over whether investors were facing a historic share market crash, similar to the global financial crisis or 1987's Black Monday, or if it's simply an overdue pullback after a stellar period of strong returns. It's been a volatile few days. On Wednesday, US stocks bounced back and calm returned to Wall Street after Japan's market soared earlier Tuesday to claw back much of the losses from its worst day since 1987. The S&P 500 was rallying by 2.1% in afternoon trading and on track to break a brutal 3-day losing streak. The volatile conditions erupted after the US Federal Reserve hinted after its 31st of July meeting that interest rates would soon be cut in what was initially seen as a stimulus for shares. But the gains quickly evaporated as investors reinterpreted the impending rate cuts as a sign the world's biggest economy was faltering. Several pieces of economic data, including manufacturing, durable goods and, crucially, jobs and payroll data, raised questions over the health of the US economy, with the well-regarded SARM rule signalling a recession. This indicator, which is triggered when there is a rapid rise in the unemployment rate, has correctly identified every recession since the Second World War. AMP chief economist Shane Oliver said recession fears are now back with a vengeance, particularly in the US. Nick Healy, a Sydney-based portfolio manager at Wilson Asset Management, said that the US data proved to be softer than expectations, triggering a strong market reaction. It's fair to classify it as an unwinding of positioning, but my view is that it's hard to extrapolate too strongly into the future from 1 month of economic data, said Healy. After a weekend break to digest the news, a rout took hold in Asian and Australian markets on Monday and swept through European and American markets later in the day. Wall Street's gauge of fear, the CBOE volatility index, shot up above 65, levels not recorded since the pandemic and reminiscent of the GFC before settling. The S&P 500 lost 3% on Monday, while the tech-focused Nasdaq shed 3.43%. While both figures were remarkable, They were more modest than what the futures market initially pointed to, providing some relief to traders and raising hopes the sell-off would turn into a full-blown meltdown. Even after the losses, the benchmark S&P 500 index is still up more than 9% since January, as is the Nasdaq. Shares, stock markets indices that had risen the most tended to fall the furthest. Chipmaker Nvidia, which had led a period of robust returns for the tech sector, was down by as much as 15% at one point on Monday before halving its losses, while Bitcoin also fell sharply. Australia's share market suffered its worst day since the onset of the pandemic, erasing more than $100 billion in value from local stocks in a single trading session. But it was Japan's Nikkei which came under the most extreme pressure, plunging by 12% on Monday before rebounding strongly on Tuesday. Investors have been concerned about the state of the Japanese economy and the recent effects of the strengthening yen, which has unravelled the so-called carry trade, in which investors borrow cheaply in yen and buy higher yielding assets including the US dollar. Analysts had warned that the yen carry trade was unwinding, triggering margin calls and forced selling. Online trading firm IG said that it suspected the frenzied market action in Japan was the final act of cleansing of long positions in the Japan trade, referring to investors who were caught up in the yen carried trade. Some safe haven assets such as bonds proved to be among the few hiding spots from the turmoil, with the sharp moves challenging all the sure bets of recent months. That upbeat sentiment had been underpinned by optimism about AI technologies and the wider tech sector, along with expectations inflation would cool, job markets remain robust and economies emerge from the inflationary period intact. While it's too early to tell whether the selling pressure will abate, at the very least the sharp falls are a warning shot. The global recession concerns of recent years have been tied to a fear that cost of living pressures will eventually depress spending to such an extent that economies will shift into reverse. One canary in the coal mine investors look to is American online furniture and home goods company Wayfair, which warned on Thursday that customers were very cautious after recording a near 25% fall from peak spending levels recorded 3 years ago. This mirrors the magnitude of the peak-to-trough correction the home furnishing space experienced during the Great Financial Crisis, Wayfair Chief Executive Niraj Shah said on the earnings call. While those discretionary spending figures support a case for an ensuing bear market, investors also have an eye on the upcoming US election and associated spending initiatives which could act as another stimulus for shares. Traders and analysts struggle to explain the extremity of Monday's sell-off. There must be some forced or technical selling, as the fundamentals did not change by 11 to 12% in one weekend, said Kiran Ganesh, multi-asset strategist at UBS. He added that he saw a sharp sell-off as a buying opportunity. Others, including Nicholas Smith, Japan strategist at CLSA, pointed to the exaggerated impact of the algorithm trading programs, which may have specifically responded to the recent sharp upward move in the yen. It does look like they are correlated with the yen, Smith said. After all the excitement about the prospects of AI, it now looks like AI may have got us into this mess. And Elon Musk's social media platform on X on Tuesday sued a global advertising alliance and several major companies, including Unilever, Mars, and CVS Health, accusing them of unlawfully conspiring to shun the social network and intentionally causing it to lose revenue. The company, formerly known as Twitter, accused the defendants of a massive advertising boycott. X filed the lawsuit in federal court in Texas on Tuesday against the World Federation of Advertisers as well as the companies individually. We tried peace for 2 years, now it is war, Musk tweeted on Tuesday. The lawsuit said advertisers, acting through a World Federation of Advertisers initiative called Global Alliance for Responsible Media, collectively and maliciously withheld billions of dollars in advertising revenue from X. The company said they acted against their own economic self-interest in a conspiracy against a platform that violated US antitrust law. In a statement on Tuesday about the lawsuit, X's chief executive Linda Yaccarino said, "People are hurt when the marketplace of ideas is constricted. No small group of people should monopolise what gets monetised. The consequence, perhaps the intent of this boycott, was to seek to deprive X users, be they sports fans, gamers, journalists, activists, parents or political and corporate leaders of the global town square," she wrote. Maybe when it goes to trial, Musk can explain to the judge why he told advertisers to go F yourselves. And Australia's central bank kept interest rates at a 12-year high and all but ruled out a rate cut in the next 6 months, splitting with global counterparts as it waits for inflation to abate. The Reserve Bank held its cash rate at 4.35% for a 6th straight meeting on Tuesday and lifted its forecasts for inflation and economic growth. In her press conference after the policy decision, Governor Michelle Bullock said there's still a risk that inflation will take too long to return to target, and said it's too early to be talking about imminent easing. The market path at the moment is pricing in interest rate reductions by the end of this year, the Governor said. The board's feeling is that in the near term, by the end of this year, in the next 6 months, given what the board knows at the moment and given where forecasts are, that doesn't align with their thinking about interest rate reductions. Money market had paired bets on a November rate cut while fully pricing one for December. And the nation's struggle to build enough homes for a growing population will be probed by a new Productivity Commission inquiry. Government red tape slowing the approval and construction of homes, workforce challenges and innovation by home builders will be investigated by the federal government's independent economic advisor. The inquiry comes amid grave doubts in the housing industry that the Albanese government will achieve its joint goal with the states and territories for 1.2 million homes to be built over the next 5 years. After a building boom during COVID-19, fueled by low interest rates and government stimulus payments, total dwelling approvals plunged by 163,320 in the year ended June 30, the weakest result since 2011-12. It's well short of the 240,000 annual target required to meet the medium-term goal of governments. A perfect storm has constrained the building of homes. Suppressing supply are higher interest rates for developers, soaring building material costs, higher wages for construction workers, elevated land prices and slow approval processes by state and local government agencies. At the same time, demand for homes has surged due to more than 500,000 net overseas arrivals and fewer people living in each home on average, due to them wanting more space to work from home and other lifestyle choices. Expensive housing construction costs and rents have contributed to elevated inflation in the past 2 years. Productivity in the construction industry has been stagnant over the past 2 decades, making costs in this industry more difficult to contain. The Productivity Commission is commencing self-initiated research into productivity in Australia's housing sector. It will investigate issues that might be weighing on productivity growth in the sector, such as barriers to the adoption of innovation and scaling up government regulation at local, state and federal level, and characteristics of the construction workforce. Sydney-based housing developer Mark Bainey of Capio Property Group said the number one problem facing home builders was a shortage of skilled workers such as carpenters, plumbers and electricians. The key thing holding back construction at the moment is the supply of skilled labour, Mr Bainey said. We have a lot of unskilled labour, but not enough skilled labour. Nobody wants to study a trade or be a tradie. The migration rules are not bringing enough skilled migrants. They're bringing in yoga teachers, but not enough tradies. A common complaint for builders is that tradies are working in higher paid jobs on government-funded infrastructure projects. Housing Industry Association Chief Economist Tim Reardon said government red tape was making home building more expensive and causing a decline in the sector's productivity. This included laborious state and local agency planning approval processes, higher taxes on foreign investors, 7-star sustainable building rules, tougher carbon abatement regulators for new homes, and a high level of wheelchair accessibility, he said. And Penfolds owner, Treasury Wine Estates, will sell its more affordable wine brands, including Wolf Blass, Lindemans, Yellow Glen and Blossom Hill, as that segment suffers from an exodus of budget-strapped drinkers. The company announced on Tuesday that as part of a structural 6-month review, it will exit its commercial wine brands, which sell for around $10 a bottle. The ensuing $354 million impairment related to goodwill and the carrying value is equivalent to $290 million after tax. Treasury signalled there may be more to come from its structural review, with an outline of its future operating model to be made at its full-year result on August 15th. The company has been assessing the merits of completely demerging its luxury wine business from its mid-price wine unit. Consumers globally are shifting to higher price, higher quality bottles of wine, but are consuming less overall. And the nation's most influential corporate governance advisor, Ownership Matters boss, Dean Patch, is demanding to view hidden court documents linked to the super retail group workplace scandal and legal battle, arguing shareholders should know the true value of the legal and financial threats facing the retailer, as well as any government deficiencies on the board led by Chair Sally Pitkin. Mr Patch and Ownership Matters made a submission to the Federal Court to view the statement of claim made by sacked Super Retail Chief Legal Officer Rebecca Farrell, which was kept confidential in court last week. Justice John Haley spoke of a document request from an investor consultancy organisation. Mr Patch, one of the founders of Corporate Governance Advisory in Australia, has also aimed his guns at the Federal Court's recent rule change, denying non-parties public access to crucial court documents, such as the Statement of Claim, until there is a directions hearing, which can take months. Mr Patch described the ruling as curious, saying courts were running a protection racket for companies and the hurt feelings of directors that flies in the face of the fundamental concept of open justice. Mr Patch, who is the ears of some of the nation's largest super funds and fund managers, is closely following the court case and scandal now gripping super retail, flowing from claims from whistleblowers including Ms Farrell about allegedly improper workplace behaviours, bullying, harassment, and that Chief Executive Anthony Herity was having a secret affair with his then Head of Human Resources, Jane Kelly. Alongside the media, Ownership Matters made a submission to view Ms Farrell's statement of claim, where it is believed she details the events leading to the scandal, the inner workings of Super Retail's whistleblower policy, and any corporate governance claims or failings concerning the board, Chair Ms Pitkin, and the Head of the Risk Committee, Ms Chaplin. And Prime Minister Anthony Albanese is facing growing calls for a royal commission in the CFMEU, with the Business Council of Australia warning an administrator is wholly inadequate to investigate the union's misconduct. Former judge and the recently departed Commissioner of Victoria's anti-corruption watchdog, Robert Redlich, also warned that watchdogs were limited in their powers and federal and state and Labor governments must do more to clean up CFMEU construction. It will launch a campaign on Monday for members to come forward amid fears that confidentiality and retribution are preventing known whistleblowers from speaking out. The Fair Work Commission, tasked by the Albanese government on Friday, made an application to the Federal Court to put the CFMEU's construction branches under the control of independent administrators. New South Wales Premier Chris Minns said his government would on Monday file an application in the Industrial Court to appoint an administrator of the CFMEU's New South Wales branch of the Construction General Division. However, there had been reports that Fair Work was struggling to get the evidence it needs to put the CFMEU into administration because it is not legally allowed to access critical police information or investigate the alleged criminal identities that have infiltrated union ranks. BCA says the advice from the organisation's General Counsel backed concerns that the CFMEU administrator would not have the power to properly investigate the union, even if it is successfully appointed by the court. And it's the profit reporting season. Operating earnings at Energy Australia, the country's third biggest electricity and gas retailer, reached 611 million Hong Kong dollars. That's 122 million Australian dollars in the 6 months ended June 30, bouncing back from a loss of 590 million Hong Kong dollars in the year earlier half. Credit Corp posted an underlying profit of 81.2 million in FY24, down from 91.3 million a year earlier, while revenue rose 10% to 519.6 million. Net profit after tax took an even bigger hit, slumping 44% to $50.7 million, largely due to impairments in its US loan book. And that's it for this week. And next week I'll be talking to Nexi Australia's corporate advisory partner, Brett Goldman, about the latest M&A trends, which overseas countries are the largest acquirers of Australian companies, and M&A trends looking forward. And I'll talk to economist Saul Leslake about Australia's inflation outlook, its economy and the RBA. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. If you like Talking Business, please leave us a review with Apple Podcasts. Thank you in advance. In the meantime, you catch me on Facebook, Twitter, Instagram, LinkedIn and YouTube. And if you want, leave a comment. If you want to contact me, email me at leon@leongettler.com. I answer all emails. Also, in my copious spare time, I have a copywriting business. If anyone needs newsletters, blogs, articles or advertorial, email me. Wishing you all a safe and healthy week and looking forward to bringing you Talking Business next week.